In this episode, we are going to talk about why Bitcoin will never have a role in the international monetary order and why Bitcoin will never replace the US dollar. This episode series is called Economics Design. In this series, we're going to unbox all the different kind of economic principles that governs the design of digital systems. This could be blockchain-based, not blockchain-based, it could be frequent flyer points, or even your esports. Today's topic is going to be very focused around international monetary order and how cryptocurrencies like Bitcoin can play a role and how this can evolve in the future so that it can play a more significant role. Today we're going to cover quite a bit of things. The first part is going to be a very simple answer. The answer will be done in 30 seconds because I understand that some people prefer something a bit more easy and straightforward, so that's the answer for you. For those who want to stay longer and want to go in depth into understanding all the logic and principles behind the answer, that's where the rest of this podcast will be. We are going to talk about the history of international monetary order, the lessons learned from the different iteration of this changing order, the lessons learned from it, Bitcoin's role in it, and 2 reasons why Bitcoin failed in this international monetary order. So to get you started, the short answer really is that Bitcoin will never be a medium of exchange or unit of account when it comes to international trade. It will continue to exist on a retail and P2P level, and it can still be used as a store of value for everyone, and that's it. So it's really designed for a P2P, a very retail level, and not a wholesale international finance, international economy level. And that's the short answer. If you want to know more into details about how I came to this conclusion, just follow me. Let's take a recap on what is the international monetary order. We have to go all the way back to 1879. Sure, before 1879, there were a lot of different other types of monetary orders, including the free banking era, but that's really not very relevant because it was not coordinated on an international level. The international gold standard was one of the first macro ways of coordinating all the central banks and coordinating all the other countries and their monetary policies together. So we're going to start at that period. Now, in 1879 to 1913, we are in this period known as the International Gold Standard. Basically, money was backed by gold. Then the Great Depression happened, World War II happened, and in 1945 we started the Bretton Woods Agreement. Instead of pegging money to gold, we move away from gold and we want to allow for more independent monetary policy. Then for the next 20 years, from 1950 to 1970, we had the fixed rate dollar standard. Instead of pegging money to gold, we peg it to the US dollar, and the US dollar was pegged to gold. Things went very well for 20 years, and then in 1971, things started to be a bit messed up. So in 1973 to 1984, we had the floating rate dollar standard. Basically, this allows for a flexible exchange rate with the US dollar, and US dollar had a little bit more autonomy in its monetary policy. Things went well again, and then it did not. So in 1985 to 1992, we had the Plaza Louvre Intervention Accords, where we had this introduction of G3. G3 included Japan, Germany, as well as the US. These 3 countries came together to govern. Basically, if you think of it as a hierarchy, you have US on top, and then the Japanese yen and the Deutsche Mark at the second layer, and then the rest of the world at the 3rd layer. That was, in general, the international monetary order. In the next few moments, I'm going to go in depth into each monetary order, the rules governing it when relevant, the drawbacks, and the lessons learned, or the problems and solutions. So then we can understand what is the international monetary order and how cryptocurrencies like Bitcoin comes into play. How does it fit into this jigsaw puzzle? We're going to start off with the International Gold Standard. I'm not going to talk much about the rules governing it because in this period, money was backed by gold. But since we're talking about Bitcoin, Bitcoin is not backed by anything, so it's not very relevant. In this International Gold Standard, money was backed by gold. So to grow an economy, if an economy needs to grow, an economy needs more money into the system, it needs to increase its monetary base. The monetary base is gold. So the central bank needs to go out to buy gold, put it into the vault, and then print more money for everyone. However, if everyone is growing at the same time, if every central bank needs more gold to print more money, there isn't enough gold in the world. What does that lead to? That leads to deflationary pressure on the world economy. And deflation is one of the things that a lot of economists are afraid of, because it led to the Great Depression, which is exactly what happened in the international gold standard. The failure of the international gold standard led to the Great Depression. There are a lot of things in between, but I'm just giving you a general summary first. The thing about deflation is that it now reduces your spending power. It brings the spending power into the future. So that means if I have $100 right now, if I choose to spend it, I can buy $100 worth of things. But if I spend it next year, I can buy $150 worth of things. So just by waiting 12 months, I gain extra $50. For most people, that's a very good thing. So people will not spend it. People will keep their money, wait for next year, and then I can use the same amount of money to buy more items. So deflationary pressure is not very good for a growing economy. If your economy is growing, demand is expanding, the world is demanding more things, then you want to keep up with the demand. You want to supply things to keep up with the demand. But if you have deflationary pressure, everyone is not demanding anything, everyone slows back down. We could return to the previous state where you don't have such massive growth in the economy, but it's not very good when we talk about economic growth. We want to see increase in GDP, we want to see an increase in GDP per capita, we want to see increase in PPP, so this is not a very good thing for central banks. The other thing is that the common price level was not stable. The good thing about the international gold standard was that everything was pretty much backed by gold, directly or indirectly. Items had a common price level because it had a reference to gold, and gold is pretty stable at that time. So in general, you have a common price level, which is very important for international trade and international finance. However, because of the crazy deflationary pressure, we started off in England, and then it carried on to the US, to France, to Germany, and then there were crazy deflationary levels, and so the common price level was not stable anymore. This led to reduction in global trade, which is one of the things that happened. And if you have deflationary pressure, so your own economy is not demanding things, you have a reduction in international trade, the rest of the world is not demanding things, then your economy growth is going to be very, very bad. So in general, that's kind of why it failed. What is the solution? The solution is to move away from gold and to allow for more independent monetary policy. Because at that time, all the countries were pegged to gold. The kind of monetary policy that could be included, that could be executed, was quite limited. So we wanted to change this. Before I move on to talk about Bretton Woods in 1945, I want to talk a little bit more about why do we need and want price stability. This topic is going to continue repeating throughout this entire episode, and this is something that's very important in general to keep in mind when talking about what central banks are doing and why they do what they do. Because the mandate for all central banks around the world is to maintain price stability. And this is why. Two general big reasons. One is to avoid long-term inflation or deflation. So with price stability, you don't have crazy volatility in prices. So that's good. We're going to explain that later. The second is that it contributes to economic activity and employment, which is very important because as a central bank, or as a government in general, it's not just about ensuring that people have jobs or people have food or there's low crimes, but it's to ensure that you grow the economy and people always have jobs. It's very important. So how does price stability affect all of this? Let's think from a perspective of a business with investment or a household with investment. Let's focus on investment. When we have price stability, it allows for transparency in price mechanism. That means you know that in general, prices will roughly be like that. It could be 2% different from this year and to next year, 2%, but you know the rough confidence level where prices will change. It's not like this year is going to be $1 and next year is going to be $3,000 because we're not talking about hyperinflation. So because of this price stability, because we have some idea of what prices will roughly be like, the expected price level of next year, we can make better decisions financially to invest and allocate them to different resources. The other thing with price stability is that it reduces inflation risk premium. So what does that mean? It means that the real interest rates is now lower. And as an investor, you can borrow money at a cheaper rate because the real interest rate is lower. This is very good for investment because then once again, people will use money to invest it in the various resources and the various areas that require investment to grow the GDP. And lastly, it's talking more about financial stability, because when investors are making decisions, two things they think about. One is, do I invest it now, and where do I invest it? Do I invest it in this current period? So do I invest it in the S&P or specific companies, and how do you allocate the resource? Or do I invest it in my company and then I can hire more people? Or I invest it in other people's company, they decide how they want to use the money. Or the other thing is where I look at the economy and say, you know what, I think inflation is going to happen, and I really want to hedge against inflation, because inflation means the power of my money has gone down, and I don't want that. I want to buy more things with my money. So I'm not going to do that. Instead, I'm going to put my money in somewhere safer as a hedge against inflation. There are a lot of papers talking about this. I can link them to you if you're interested. But basically, it's a hedge against inflation. One of the best things, or one of the best resources, is gold. To an investor, I have $100. Instead of putting it into the S&P, I decide that I want to hedge against inflation. So I'm going to put my money into gold so that I can use it in the future when the economy is a bit more stable and the prices of gold increase, and then the value of my $100 has increased. So I'm basically making a decision to spend it now or spend it in the future by hedging. So what does this mean? For the investor, it's the same. I have $100. It's not in my bank. It's either in the market or in gold or in some other assets working for me. Okay, that's fine. But what about the economy? What about central banks? Because this is a mandate by the central bank. So how does this affect the central bank? The central bank now looks at this $100, and the central bank looks at it in the way where, okay, if this person puts it into the economy right now, this $100 will generate returns. This $100 will either help a firm to be more productive, increase in GDP, to hire more people, increase in GDP, or to contribute in one way or another, increase in GDP. Whereas if this person puts the same $100 into something like gold or a different asset, it's not working for the economy. It's just being dormant, staying somewhere, and not adding to the GDP, adding to the bottom line. This is why it's very important to have price level stability from a government point of view, because it encourages productivity, it encourages economic growth, it encourages investment, it encourages GDP growth. And that's why we want price stability. Of course, we are also not saying that we need 10% increase every year so that it entices people to spend more. We're just targeting a 2%. Fun fact, this 2% was mentioned kind of casually by John Maynard Keynes before the Bretton Woods, or during the Bretton Woods Agreement, and we just stuck through with it. So that's fun. Okay, now let's go back to the regular scheduled program of the Bretton Woods Agreement. The Bretton Woods Agreement started in 1945, and remember what date that is? That was after the Great Depression, after World War II. So two major things happened in the world, and then we needed a new international world order because clearly the gold thing didn't work. It caused the Great Depression, and then a lot of other things happened, and then World War II happened, and so a lot of things were not doing well. So we need a new international monetary order to coordinate all these economies again. Economies were recovering, economies wanted to grow again, countries are consolidating their resources so that they can grow again. And that's where the Bretton Woods Agreement comes in. What does it do? It has a few rules, but I'm just going to take 3 rules out that is very relevant to our topic. The first one is they control exchange rates in the short run, but allow it to change in the long run. That means in the short run, exchange rates are pretty much fixed, just like the gold standard. But the difference is that in the long run, you can change the exchange rates, which is different from the gold standard, because for the gold standard, it's the fixed rate, short run, and long run. In this Bretton Woods Agreement, you can change it in the long run. Why do we want to change it in the long run? Because remember, this was the period after a lot of economies collapsed. And when economies collapse, they need to rebuild. And when you rebuild, your economy becomes stronger, your currency becomes stronger, and that's why there is a change There needs to be a change in exchange rates. It also requires countries to sterilize the domestic monetary impact on exchange market interventions. This is where we had a little bit more introduction to exchange rate interventions, where we use the US dollars to intervene when there's a difference in balance of payments. So that means USD will be introduced into the economy by increasing or decreasing the supply. Then everyone else around has to change their monetary policy to adapt to this impact. So that means they have to buy or sell their financial bonds or government bonds. The other change is that instead of just using gold, now things are backed by gold and SDR. SDR, I talked about it in the previous episode on Facebook's Libra, and it is basically a basket of different currencies coming together to form like a neat little basket. So now money is backed by gold and SDR. Just a quick crash course again. What is sterilizing money? Sterilizing money is to limit the effect of capital flow. So when we talk about an international market or exchange market intervention, capital flow is the increase and decrease of USD. How do we edit that? How do we affect that? By buying and selling financial assets, government assets. So you buy and sell US bonds, or you buy and sell your own country's bonds. So what was wrong with the Bretton Woods Agreement at first? Gold was still used as a basic standard. So then the solution was to move away from gold to USD as a base or anchor currency. And that's how we got to the 1950 with the fixed rate dollar standard. Instead of pegging currencies to gold, we peg it to USD, and it's a fixed exchange rate. USD is used as the intervention currency. Remember I talked about exchange market intervention? The tool or the medium to do this exchange rate intervention was the US dollar. And because USD is the one intervening when things are going wrong, the US is passive to foreign exchange. So they don't, in their mandate in this rule book of this period, USD can't change their exchange rates to be more favorable to specific countries for trade agreements. So they are passive, they're very independent when talking about their own monetary policy. In the international gold standard, we talk about price stability. When we talk about price stability, we need to anchor price to something. So we anchored price to gold because gold's price was relatively stable. Everyone can agree that, okay, this gold is roughly this price. So all the goods that we want to trade will be pegged against gold. So maybe this asset worth 4 ounces of gold, and that asset worth 12 ounces of gold. And in general, we have a level of international price stability. Now we don't use gold anymore, so we have to use something else. We can't really use US dollar instead because the value of currency changes. However, the US monetary policy or the US Federal Reserve will be using its economy as an anchor. We call it nominal anchor, just an anchor, to anchor for world prices. So what does that mean? It means that instead of using gold as anchor, we use the US market as anchor, and the central bank of the US will just be anchoring their monetary policy to the economy, and everyone else follows. Do you see how this is a rise in power of US? Because also remember, one of the things that happened concurrently with the Bretton Woods Agreement is the Marshall Plan. Because after World War II, a lot of European economies went down, was completely dead, or was in a very bad situation. So what did the US do when all these European countries are not doing good? They loaned them a lot of USD, which is the Marshall Plan. So there was an inflood of US dollars into the European market already, and now with the fixed rates dollar standard, a lot of things will be denominated in USD. So US now played a role where it is not only the international central bank of the world, it was also the anchor for world prices, so that everyone has a rough standard, a rough base of world prices to trade. And the US was also the net international creditor. Basically, US is the bank of the world, which kind of is what's going on right now as well, to an extent. So what is the problem? The thing is, it's going very well for 20 years. However, there was some issues involved. The first one is that, sure, it says to fix interest rates in the short run, and in the long run allow for interest rate changes. However, this did not happen. Why? Because remember two things that happened with the US dollar. The first one is that it flooded the European market because US loaned money to Europe. And the second was that USD was used as a settlement layer because US was the international currency for intervention, for market intervention. So a lot of things in the settlement layer was done in USD. That means your balance of payment, your trade with other countries, everything was done in USD. And it was a lot easier since money was lent in USD anyway. So because of that, even if you want to change, even if you're doing a lot of different trade and in USD and then your local trade in your local currency, it's just easier to have a fixed exchange rate for accounting purposes. So that was one reason why there was fixed exchange rates. The second thing is that countries recovered, but the fixed exchange rate was still there because to edit the exchange rate, then you have massive capital flow. And this will threaten international finance because remember, we want price stability. With crazy large capital flow, with changes in exchange rates, then the economy is a bit more unstable. And remember, at this stage, countries are still recovering. Countries needed a bit more stability in terms of investment, in terms of growth, in terms of consumption. So the government doesn't want to threaten this too much. And lastly, USD was still linked to gold at $35 per ounce. So what the tipping point that caused all of this to fail is that there was a fear of run on USD. You know, like the run on bank, where everyone goes to the bank, withdraw all their money, and don't trust the bank anymore. Something similar happened. It didn't happen in like extreme full scale, but it's more little chatters of people saying that, you know what, USD is still linked to gold at $35 per ounce. So I think it's safer to have gold in my central bank instead. So the country goes out to buy gold and then put it in your vault instead. And because of that, there was a lot of instability and this thing failed. So what was the solution? The solution is to allow for floating exchange rate instead of just a fixed rate. This makes sense since countries were recovering. So what happened? In 1973, we had the floating rate dollar standard. This allowed for flexible exchange rates, which is good because now countries were stronger, their currency is stronger, and then they allow for more collaboration and different forms of coordination. The other change in the US Federal Reserve is that now they can still have their monetary policy independence, but they do not need to anchor a common price value. Remember before, we talked about how price stability is super important. And because there's price stability, it's the way to coordinate all the countries and their monetary policy. Before that, we had gold as the price stability. Then we had USD as the price stability. Everyone anchors to USD. Now, everyone can still anchor to the USD, but the US central bank, it's not going to anchor any common price value. So you see where this is going. And what happens? Well, the dollar appreciated crazily due to monetary policy independence, and then things started to fall apart because the other countries could not keep up with the crazy dollar appreciation. So then we thought, okay, before that, the world is just USD on top, the rest of the world below. Now, maybe we need some form of international governance for USD. So we split that up into USD, something else, and then the rest of the world. So the something else is going to more or less govern the USD. And that brought us to the Plaza Louvre Intervention Accords. This is where things started to change a little bit more. Now we have, instead of USD being the top, we have USD, Deutsche Mark, and Japanese yen. So US, Germany, and Japan at the top three, bit above the rest of the world. USD was still the top. USD was still the main intervention currency, but Germany and Japan come together to help manage what the US is doing. So they have very broad exchange rate between these three countries. Germany and Japan will intervene when needed, and they will hold each other's currencies in reserves. However, one of the very important mandate is that in the long run, these three currencies will help to stabilize the national price level in tradable goods. For goods that you don't want to trade, that's only within your country, do whatever you want. It doesn't affect the rest of the world, it just affects your country. But when we talk about tradable goods, go back to the point on price stability, and we need to stabilize national price level so that the rest of the world can anchor to that, and there will be a result of price stability in an international level for tradable goods. So the rest of the world, as usual, just buy and sell US dollars accordingly. So this was the change. Instead of just USD on top, rest of the world below, you have USD, and then Japanese yen and Deutsche Mark, and then the rest of the world. Japanese yen and Deutsche Mark is not exactly the intervening currency, but because they hold USD, they can intervene indirectly. A thing to note as well is that at the same time, Deutsche Mark had a huge dominance in the European monetary system. This was way before the Maastricht Treaty, where we had the euros in 2001, and each country in the EU or in the European monetary system had their own currency. So in the same way where USD is the top and the rest of the world is below, this is where the Deutsche Mark is at the top and the rest of the European monetary system is below. So Deutsche Mark plays a very important role here because it's not just helping to stabilize international prices with Japanese yen and USD, but it's also anchoring the price level in the whole European monetary system. So it's playing a big role in terms of managing interest rates, managing price level. And there was also independent monetary policy. The rest of the European countries had to follow it. So that's in general the summary of what happened from 1879 to about the 1990s. What are some lessons that we can learn from this international monetary order? The first one is that the anchoring job should be given to one monetary authority, and that is very effective. Because, well, in economics, we call this the redundancy problem. I'm not going to go very much into that, but if you're interested, go and read up about it. Basically, we don't need every country to be anchoring. We just need one country to anchor, and because of international trade, everyone will trade together, and you just have one country to anchor. Everyone will anchor against this one country. So we started in the international gold standard. We had gold to anchor. Everyone anchored to gold. That worked for a while, then it didn't work. Then we anchored to USD. That worked for a while, and then there were other problems, so we didn't anchor to that. And then we had the G3 coming together to anchor prices in the long run, and that worked for quite some time. So the important thing to note is that we need price stability, and to get price stability, we need to anchor it to something. And the other thing is financial stability. It's not just price stability, but we need to talk about financial stability. Other countries will stabilize their exchange rates against the anchor currency, the anchor one with price anchor, when it's combined with greater financial stability. And price stability results in financial stability, once again, because of investment, because of economic growth, because of employment. So it's very important to have price stability and financial stability. Once the anchor country has that, or the anchor entity has that, like gold, everyone will voluntarily stabilize to that because it's a lot easier to coordinate. At the end of the day, international monetary order is just a way to coordinate all the different monetary policies, all the different central banks, all the different currencies together so that you can do international trade and you can trade a lot more efficiently without crazy arbitrage, without crazy deflationary pressures, or without unfairness to any specific country. So what is Bitcoin's role in the international monetary order? That's the entire part. How does Bitcoin play in this entire order? We talked about the history, we talked about the lessons learned. Where does Bitcoin come in? Remember, a currency has three functions: a store of value, a medium of exchange, and a unit of account. Bitcoin can continue to have a store of value. Could it replace gold, as in, instead of having gold in the international gold standard, we have all the other countries that's pegged to Bitcoin instead? Well, as you can imagine, whatever happened to gold will also happen to Bitcoin because there's limited supply, there's a fixed supply, and it doesn't allow for the increase or the expansion in monetary base, which is the expansion in Bitcoins. I know a lot of people are saying that we should just have all the central banks in the world have Bitcoin, and then we just issue money based on Bitcoin. Okay, that could work, but we will go back to the international gold standard again, where when economies are expanding, we don't have enough Bitcoins to support that. So that's one of the problems with it. However, that's not to say that central banks can't keep some asset in Bitcoins if they want. So central banks can have gold, Bitcoin, SDRs, other reserve currencies in the central bank, and then issue money against that. That could be a solution, but we're not going to go back to the international gold standard and change it to the international Bitcoin standard. In fact, Bitcoin prices are not stable as well, so with gold it's a bit more stable. So you can have price stability by anchoring assets to Bitcoin, to gold. But with Bitcoin, you can't anchor assets to Bitcoin because it's just different. It's fluctuating so much. The second thing is medium of exchange. When we talk about medium of exchange, we're talking about balance of payment, we're talking about trade between countries. Remember, this is an international monetary order, not a retail P2P. For retail P2P, you can still do your medium of exchange and unit of account in Bitcoins, whatever you want to do. But when we're talking about international order, when we're talking about trade between two countries, then to use Bitcoin as a medium of exchange is difficult. Sure, the good thing about Bitcoin is that it is independent. Just like gold, it is independent roughly from whatever that's going on. It's only the prices change because of the trade in secondary market. But it's not like USD, where it's not independent because it's always tied to whatever the central bank is doing. So because it is independent, it's generally a good idea to use something independent as a medium of exchange. But remember, once again, Bitcoin is fluctuating so much, there is no stability, and it's going to be very difficult to use as a medium of exchange. And lastly, the unit of account. When it comes to unit of account, Bitcoin, once again, is very unstable. One reason why USD became so prominent in the unit as a unit of account was that accounting, trade, balance of payments accounting, and international trade accounting was all done in US dollars. And it was a lot easier to do. All the books around the world are done in US dollars. Now, to replace that with Bitcoins, firstly, it's going to be quite difficult. Secondly, Bitcoin has there's a lot of zeros. I think there's 18 decimal points to do. And to have a book with so many decimal points is very, very tricky. At least for non-decimal points, when the numbers go on the other side, like 1 million or a few trillion, you have commas to separate the zeros. With decimal points, you don't really have that, so it's quite difficult to do accounting in Bitcoins. Not to mention, you're going to ask everyone to change it to Bitcoins, and Bitcoin prices fluctuate all the time. So it's very difficult for Bitcoin to be a unit of account. So here's two reasons why Bitcoin has failed. The first one is that there is no nominal anchor. Remember, everything that we talked about was about price stability. And to get to price stability, we need a nominal anchor, or we just call it an anchor. So because of that, there is no discretionary control over the monetary base of Bitcoin. It is good because Bitcoin is independent. It is good because Bitcoin is not governed by anyone. It's just governed by code and machines. And so it's not going to be subjective to anything. It's a very objective asset. But because of that, there is no control over the monetary base. And so you can't anchor Bitcoin to specific kind of nominal anchors and grow Bitcoin the way it needs to grow to respond to the economy. Instead, it's just growing as if it's living in its own bubble, which is good because that's what Bitcoin is supposed to do. But because of that, there is no nominal anchor when it comes to the monetary policy of Bitcoin, and so it's very difficult for other countries to be pairing against Bitcoin. Also, Bitcoin has no price stability on its own. It's fluctuating crazily. It's very, very volatile. So it's very difficult for it to be a nominal anchor and very difficult for it to become a proxy of of price stability. The second thing that we talked about, price stability and financial stability, right? There's also no financial stability because there's no global exchange stability. The monetary policy of Bitcoin, because the sole purpose is for a P2P, it's not going to think about other like financial stability. It's not going to think about inflation rates. It's not going to think about economic growth. These considerations are not embedded into the monetary policy of Bitcoin. And so Bitcoin is not going to edit their monetary policy against whatever that's going on in the world. And because when you don't do that, you're not targeting for greater financial stability. There is no incentive for other currencies to be hedging against Bitcoin or to anchor with Bitcoin. It means that Bitcoin is not gold. Bitcoin is not gold where it's stable, and then all the other countries or all the other currencies can pair against it. Bitcoin is fluctuating so much, and countries want stability. Bitcoin is really not the thing that gives stability. Second, so that's where countries or currencies price against Bitcoin. Now, Bitcoin is also not going to price against other currencies because it's not going to change its monetary policy. Its monetary policy is fixed, and it could change the exchange rates. It could change the how much people hold or give out or spend Bitcoins, but it's going to be very difficult to manage that since it's a decentralized P2P currency. So what is the next step in international monetary order? Remember, we need two things: price stability and financial stability via interest rates. So we have the financial stability part with SDR, and now we have to look a little bit deeper into the price stability. So instead of fixing exchange rates or monetary policy, we need a base international monetary order with a common price index. So that means instead of fixing prices, of looking at price stability with gold or looking at price stability via the US dollars, we need a new nominal anchor. And then the rest of the central banks will remain fixed par value for the exchange rates to this nominal anchor. And this is where we can get a little bit more coordination within all these different currencies. So to answer the question, will Bitcoin ever play a role in the international monetary order? No, Bitcoin will never be an international currency. Bitcoin will never play a role in the international monetary order. However, if you ask the question of will cryptocurrencies or can cryptocurrencies play a role in the international monetary order? Absolutely. How? Because right now we're talking about countries and economies that goes beyond a geographical constraint. We're talking about digitization. We're talking about trade of flow between people living in Singapore and the US, and you don't even need to do anything. You can just trade, and goods and services will be transferred abroad. So trade is not just constrained with the geographical distance. That means any privately issued currency, it could be Bitcoin, it could be Facebook's Libra, it could be any privately issued currency on blockchain or not on blockchain, they can come up to the similar level as major international currencies, because we're still talking about currency as a way to trade, as a way to account for things, to say that this asset is in like 0.5 Bitcoins, and then we can just trade Bitcoins. And it's also a store of value depending on however the currency has a store of value. So basically, the international monetary order is going to expand. It's going to expand to more than just sovereign currencies, but also now the new international monetary order has to consider other types of currencies, privately issued currencies with a lot of following, with a lot of people using it. It can talk about company-issued currencies. It could talk about independently issued currencies. As long as it's a currency that people use and accept, then it's very important to include them into the international monetary order. All the time before now, international monetary order is always a sovereign currency. But now we need to expand the scope. We need to expand the scope to realize that, hey, you know what? Sometimes or sometime in the future, we're going to have a currency that's independently distributed, independently issued, as long as it's with regulations. And because of that, we need to have an inclusive international order to include them as well, so that we can have better coordination between the private and public sector. And this is a very important stage right now to think about a new international monetary order and how do you combine these two big markets, the private and public market, together so that they can work together, coordinate, and really benefit the regular household, regular people like you and me. Otherwise, it's going to be a constant fight, and the only casualty is going to be the regular people like you and me. So we need to foster greater coordination, and this is where we can start thinking about a new international monetary order. Let me know what you think in the comments below. If you're interested in more topics like this, you can sign up to our course on Tokenomics Blueprint, and it's having a discount now, so you can just scan the QR code or just go to bit.ly/tokenomics201. Till then, I'll see you next week. Bye!